What's up, everybody? Welcome again to another video. Today we're going to discuss and try to review how we can use the 8 pillars. That is, this 8 pillars is not my idea, completely not mine. No credits to me. All credits to the guys from Everything Money who did this. And today I'm just gonna show you how you can actually value a company and take the stock price and compare it to its intrinsic value as a company itself. And so what we want to do here is what we want to emphasize as a value investor. Do I really want to pay this price for this company, or is it overpriced, or is it undervalued? So that's the place where we want to go. Today we're going to look at particularly Apple stock. Okay, so currently Apple is trading at 148.76. That was the closing price. And so the first step from the 8 pillars is the 5-year average PE ratio. We want the 5-year PE ratio to be less than 22.5. Right, so we've already open some of the metrics here for you guys. So Apple's PE ratio for fiscal years ending September 2016 to 2020 is averaging around 20.3. So we're less than 22.5, so that's a check mark. Right. The second one from the 8 pillars is a 5-year return of invested capital should be more than 9%. So I already have it here. It's in Finbox. Okay, Apple's operated at median return on invested capital of 24.1% from fiscal years ending 2016 to 2020. So it's a check mark there again. So we're above 9%. All right, 5-year. Now the next one is revenue growth. So let's take a look. I'm here at the trading view in case you're not familiar. So I'm gonna open the financials. This is an Apple. Let's just make sure we're in Apple. Yeah, we're in Apple. So let's go to the financials and let's go to the income statement. So revenue growth the last 5 years. So we'll track that. So total revenue, let's go back to 2016. It should be going up. So 2014, 214, 228, 265, 259, 274, 2020. So we can see it's been growing the last 5 years. So that's a check mark right there. Number 4, net income growth the last 5 years should be growing as well. So let's find it. Net income is over here. So let's go to 2016, 45.69 billion. It's been growing to 48, 59, 55, 57. So we can see some consistency right here. Okay, so that's a check mark right there. Net income growth last 5 years. And number 5, shares outstanding should be going down year to year. So what that means is that the price that we're paying to buy an Apple is that it's not being diluted by them issuing more shares. That means we get more value for the price that we pay for the stock. So let's go there. Shares outstanding. So over here. So average basic shares. This is the one. So shares outstanding. Let's go to 2016, 21.8, 20.8, 19, 18, 17. And that means Apple hasn't been issuing more shares. That means let's say the $50 or the $100 that you put into the stock is valued more now because of they're not diluting you by issuing more shares. So that's a check mark right there. Number 5. Number 6 is go to current assets should be more than the current liabilities. So let's go to the balance sheet. So 2016, you can see here the total assets. Okay, I mean, you can see in the graphs even the liabilities, this is the blue ones, is lesser than the current total assets. So that means Apple can pay their liabilities. Okay, it would be easier for Apple to not go bankrupt because they can pay off their debts. Okay, so we can see here 2016, their current assets are more than their current liabilities in the last 5 years. So that's a check mark right there. Let's go to number 7. It says here free cash flow growth in the last 5 years. Okay, so let's go to the cash flow statement. So let's go to the free cash flow. So free cash flow is calculated by your cash from operating activities, and you minus that one to your capital expenditures. Okay, so cash from operating activities minus the capital expenditures, and you will get your free cash flow. So free cash flow for the last 5 years, 2016, 53.09 billion, 51, 64, 58, 73. So we can see this company has more and more cash flow in the last 5 years that they can pay off their debts, they can pay off dividends to shareholders. And so that's a check mark right there, number 7. And number 8, the last one, is average free cash flow. So we'll be dealing with this one, average free cash flow the last 5 years, and then we'll multiply that by 20. Why 20? Is just a starting point, according to Paul, one of the guys from Everything Money. It's just a starting point for us to gauge that these guys can pay off their debts, and as well they have the sufficient cash flow to keep the company growing. Okay, so guys, I've pulled up the calculator app so we can calculate the 8 pillar. So average free cash flow the last 5 years, and then multiply by 20. So let's just do that. Let's go from 2016, it's 53.09, and let's add 51.15, and add another one, 64.12, add it by 58.90, and add 73.36. Then we divide it by 5 years, and then we multiply it by 20, and then we have it's 1.2 trillion. So let's compare it to the current market cap of Apple right now. Scroll back here. So it says it's 2.45 trillion. So it's an X mark right there. It's screaming overvalued based on the 8th pillar. So I think we've had the last 7 pillars check mark, and now this one is an X mark. Now let's try to find the intrinsic value of the stock itself and see what are we willing to pay to get an Apple stock. Okay, so what is the price that we want to pay for an Apple stock? So here I'm just gonna use the Motley Fool financial metric evaluation. So the way is to value the stock based on the financial metrics that you have. So we're going to use the EPS and the P ratio here in a trading view. So what we can do is we'll add it first, but we have to have a specific percentage or of the last 5 years, sort of a projection of where do you think Apple stock would go. Do you think it would go 12% the next 5 years, or do you think it would go 20%? For the sake of this video, I'm just gonna assume that Apple stock would go up 20% in the next 5 years. So one, I'm gonna add it to 0.20, 1.2, we'll multiply that to our basic EPS, which is the 5.16. There you go. And then multiply that again to our PE, which is the 28.70. So we have the price there is $177. That's the price. What's the price of Apple at the moment? It's 148.76. So in the case using this financial metric, we have some room for Apple to grow on that particular price. Now, I'm gonna say to you guys, disclaimer, that this is in no way the best way to value a stock. There's so many ways to value a stock, and you have the discounted cash flow as well. And so this is just for the sake of this video to show you that you can actually compute this one just very quickly. And of course there's so many ways that you can value stock, so that's what I'm trying to say. So I hope you guys have learned something. No credits to me at all the credits to guys from Everything Money. It's a process, and what I like about it is that these guys really go deep into the financials and not just getting into the hype. So that's what I love about these guys. And if you are new to the channel and you want to consider subscribing, go ahead and subscribe to these guys, because I've been watching them since last month, and I've been enjoying it. I've learned a lot in the last month than watching other YouTubers who keep sending hype stocks, who keep telling you that buy this stock because it's gonna go to the moon. So guys, listen, if you want to be a value investor and you want to pay less to get more value in the long run, listen to them. And so hopefully you guys have learned something just by using the 8 pillars. I'm gonna put it on the screen as well, so you get to see how the process looks like. But all in all, this is by no means the formula, the best formula to value a stock. This is a process to get you screening those stocks that are it's screening with deals. So it's in a bargain. So you won't be in this trap of just buying a stock just for the sake of some neighbor of yours or some friend of yours from work told you to buy this because it's going to the moon. So do your due diligence, try to apply this process as well, and hopefully it can help you to find the best stocks, sort of screen them from the list of so many thousands of stocks out there that you're trading or investing in. So as a value investor, you can really grasp what it is to invest in a company that you think and you would have confidence just because you've opened the numbers and you look at the numbers and say, hey, I think this stock is undervalued. I think this stock is overvalued. So based on what we did, Apple is a good deal, but it's still screaming overvalue. All right. So it depends on you if you want to buy it or if you wanna put this long term up, or if you want to wait until you get your prices right. Depends on what you've researched so far. So thank you so much. Hope you learned something in this video, and I'll see you on the next one. Thank you.